All right, welcome. Today, we're going to dive into the interbank money market. Now, you'll often hear it described as the engine of the financial system. And that's a great analogy because while it operates mostly behind the scenes, its stability is absolutely critical for the day-to-day running of the entire global economy. So let's get started and figure out what its real purpose is.
Think about it. Every single day, financial institutions are processing literally millions of transactions. At the end of the day, some banks are going to end up with a surplus of cash, while others might find themselves in a deficit. And that brings up a really fundamental question. If a huge bank is running low on cash, even just for 24 hours, what do they do? Where do they go?
Well, this is where they turn. The answer is the interbank money market. And as you can see in this diagram from our source, the key players are pretty diverse. On one side, you've got your banking institutions, your central banks, commercial banks, investment banks. And on the other, you have non-banking players, things like insurance companies and pension funds. This market is the meeting point where all these different entities come together to manage their short-term cash needs. So let's formally define what this market is and talk about what we're going to cover. First, we'll nail down what the money market is and what it does. Then, we'll look at the different ways transactions happen. After that, we'll get into the mechanics of how the instruments are priced. And finally, we'll examine the huge role the central bank plays in all of this. Really, you can think of the money market as the foundational layer that keeps all the other capital markets liquid and moving. At its core, its main job is to fix these liquidity mismatches. A bank that's flush with cash can lend to a bank that's facing a temporary shortfall. This lets both of them manage their daily cash flow way more efficiently. And the way this is done is by trading short-term debt, which we typically define as anything with a maturity of less than 1 year. So how does this lending and borrowing actually work? Well, the market is really built on two main pillars: direct interbank deposits and then tradable money market instruments. Let's break down the difference between the two. On the left here, we have the interbank deposit system. This is super straightforward. It's a direct deal. Bank A lends cash to Bank B. It's a simple loan, and it's not designed to be traded. On the right, though, we've got money market instruments. This is different. An institution issues a short-term security that other participants in the market can buy and sell. This structure is what makes the debt tradable, and that makes it much more flexible. Okay, let's start with one of the most common instruments you'll see: Treasury bills, or T-bills for short. These are short-term debt securities issued by a national government. When an investor buys a T-bill, they're basically giving a short-term loan to that government. And because they're backed by the full faith and credit of the country issuing them, they're considered to have almost no credit risk. Now, moving from government debt, we have commercial paper. This is a short-term, unsecured IOU issued by a corporation. Now, because a company has a higher chance of defaulting than a government does, commercial paper has to offer a higher yield. Why? To compensate investors for taking on that extra risk. And this is a perfect example of that fundamental rule in finance: the risk-return trade-off. And finally, we've got something called repurchase agreements, or repos. These can seem a bit complex, but at heart, they're just a type of short-term collateralized loan. A dealer will sell government securities to an investor, but they do it with a preset agreement to buy them back, often just the next day, at a slightly higher price. That small price difference, that's the interest the lender earns. Okay, so now that we know what these instruments are, we have to figure out how they're valued. How are prices actually set in this market? And maybe more importantly, how do investors figure out their rate of return? This brings us to the mechanics of price and yield. Here's the key thing to understand about most of these instruments. They don't pay interest like a regular bond does, no coupons. Instead, they're issued at a discount to their face value. So an investor buys the instrument for less than its stated value, holds it, and then at maturity gets the full face value back. That difference between the purchase price and the face value, that's the investor's return. So here's the formula we use to calculate that discount price. You can see the price, P, is determined by the face value, FV, discounted by the required yield, R, over the time to maturity, T. Now let's pause for a second. Looking at this formula, what do you think happens to the price if the required yield, R, goes up? Well, a higher R means a bigger discount, so the price has to go down. This inverse relationship is a cornerstone of fixed income valuation. All right, let's put this formula to work with a practical example from our source. Let's look at example B for a Malaysian treasury bill. It has a face value of 1 million. It's got 60 days left until it matures, and the required yield is 4.5%. When we plug those numbers into our formula, we get a purchase price of $992,603. That is exactly how this discount pricing works in the real world. Okay, so that's the price. But if you're the investor, what you really care about is your return, right? What's your actual annualized rate of return on this investment? Well, that measure is known as the yield. And now we're going to look at how to calculate it. And here's the formula for that. It might look a little intense, but it's really just doing two things. First, it calculates the return you made over the time you held it, which is just the face value minus the price you paid divided by the face value. Then it annualizes that number, which just means it scales it up to what the return would be over a full year. This makes it easy to compare different investments. Let's walk through one more example to make sure this clicks. Here we've got a commercial paper with a face value of $1 million. It's bought for $992,000 and it matures in 30 days. We plug those numbers into our yield formula and we get an annualized yield of 9.7%. This calculation is what gives an investor their precise, standardized return on the investment if they hold it all the way to maturity. So far, we've talked about how individual banks use this market, but the money market has a much, much bigger role to play in the economy. It is the main stage where a country's central bank carries out monetary policy, which is how they influence interest rates and the economy as a whole. When a central bank steps into the money market, it's usually trying to accomplish one of four big things. First, and most obviously, to make sure the banking system is stable and running smoothly. Second, to put its monetary policy into action, like hitting a target interest rate. And the last two have to do with managing the effects of international money flows and its own operations in the foreign exchange markets. This diagram does a great job of showing these flows. You see, banks with extra cash can either make deposits or buy instruments. Banks in a deficit have to borrow. The central bank jumps right into this flow. It can pump liquidity in by buying instruments, or it can drain liquidity out by selling them. So here's a question for you. If a central bank wants to fight inflation by reducing the money supply, what should it do? Well, based on this diagram, it would sell instruments, which soaks up cash from the system. You know, this whole system is built to be stable and liquid, but you really see how incredibly important it is when it stops working. And boy, did it stop working in 2008. The financial crisis from that year is a perfect and terrifying case study of what happens when this engine just completely seizes up. This quote from our source really sets the scene perfectly. When Lehman Brothers collapsed, the trust that holds this entire market together just evaporated. Banks suddenly had no idea if the bank they were about to lend to would even exist the next day. This is what we call counterparty risk, and it went through the roof. As a result, lending just stopped. Think of this graph as the financial system's heart monitor during a cardiac arrest. This is the TED spread. It measures the difference between what banks charge each other for loans and the rate on super safe treasury bills. A low spread means there's lots of trust. Just look at that huge spike in late 2008. That is pure fear, a visual representation of the panic that froze the entire market. And the fallout from this freeze? It was an absolute disaster. The credit crunch didn't just stay in the banking sector, it spread to the whole economy. Companies couldn't get the short-term funding they needed to operate. This is the very definition of a systemic crisis, and it required massive, unprecedented intervention from governments and central banks all over the world. So it's a wrap-up. The money market is really like the essential plumbing of our financial system. Most of the time, it's invisible and it just works. But as 2008 showed us, if that plumbing gets clogged, the consequences can be devastating. That crisis forced a huge rethinking of financial regulation, and it leaves us with a really important question. What if we actually learned to stop this vital engine from stalling so badly ever again? Now, for a quick application task, I'd like you to go find the current 3-month Treasury bill rate and the secured overnight financing rate, or SOFR. Calculate the current spread and think about what that tells you about the health of the market today. Thank you.